Before we start today's show, I just wanted to mention our sponsor, Moneyfarm. Now, Moneyfarm is a leading digital wealth manager with over 60,000 active investors with over £2 billion invested on its platform. Now, it offers three main investment products, including a stocks and shares ISA, a general investment account, and a personal pension. By answering a few simple questions about your investment goals and attitude to risk, you'll be matched to one of the 7 globally diversified portfolios. Moneyfarm's expert team provides hands-on investment management by regularly adjusting and rebalancing your portfolio on your behalf. You'll even get a dedicated investment consultant should you want to widen your investment plan, which is something that sets Moneyfarm apart from most of its competitors. The minimum investment amount is £500 and fees range between 0.35% per annum and 0.75%, depending on the amount you have invested. Money to the Masses listeners can take advantage of a special offer where Moneyfarm will run your money fee-free for a year. Head over to moneytothemasses.com and search Moneyfarm for more information. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. So last week I explained how the price of natural gas had soared in 2021 and in particular over the last couple of months. Even after I published last week's show, the price of natural gas kept soaring. So much so that by the end of that day, the price of natural gas had hit an all-time high, meaning that the price had risen sixfold so far in 2021. As an aside, if you want to get an insight into the latest gas price moves using the stock app on your mobile phone, I'm talking about iPhones in particular here, then open up the stock app and search for TTF equals F, and you can look at the chart over any time period you wish. Now, the surge in the price of energy caused bond and equity markets last week to weaken as bond yields rallied as inflation expectations soared. And it meant that the 10-year US Treasury yield, for example, hit 1.55%, which is the highest level since May. However, within 24 hours of the last show airing, equity and bond markets stabilized after Russian President Vladimir Putin suggested that Russia may well increase its gas supply to Europe. Now, whether this is just political posturing or not, the impact of the news on the natural gas price was immediate, with the price falling more than 20% in less than 24 hours. Now, that seems a huge move, but it still means that the price of natural gas has risen fivefold in 2021. However, it was enough to give some respite to equity and bond markets. Now, if we look at how the market has moved over the last week since that piece of news, we can see that the FTSE 100 has rebounded about 2% to sit back above the 7,100 level, while the more domestically focused FTSE 250 gained just under 1%, so something a little bit more modest. Now, if we go across the pond to the US, there was an initial surge in US stock markets following the tumbling gas prices and the extension of the US debt ceiling, which is another story for another day and a can that's been kicked further down the road. That euphoria evaporated and the market is broadly flat over the last week. And bond yields have also stabilised, but they have risen a bit more. They've gradually risen back above that 1.6% level and have since pulled back just a little bit to sit just under 1.6%. Now, it means that understandably all eyes were on the latest US inflation data that was coming out just before I made this show, and it showed that the US consumer price growth rose by 5.3% in September, which is a 13-year high. Now, it was broadly in line with market expectations, so far the market reaction has been fairly muted, although tech stocks have opened higher in the US because it was slightly under analyst expectations, only marginally. So that has been a benefit for tech stocks. Now, often the market reaction to monetary policy expectations or inflation expectations tend to be delayed somewhat. So don't be surprised if we do see a subsequent reaction from markets in the next couple of days. Now, although inflationary pressures remain, the market seems to be consolidating at the moment and digesting last week's aggressive moves. Now, in the UK, the former MPC member Andrew Sentance wrote a piece in the Times that concluded that it's time for interest rates to rise, but for taxes to be held down. Now, That was quite a strong piece and actually suggests that we are almost certainly going to see interest rate rises in the near future. In fact, the market has started to price in that we will see a rate rise in the UK by December. Now, interestingly, the value of the pound reacted very little to this news, even though you might expect it to strengthen, which often it would do if there was going to be any whiff of an interest rate rise. But it still sits around the $1.36 level, for example. But when considering that dollar pound exchange rate, the stalling has also been a result of the dollar strengthening. And the reason for that strengthening of the dollar is the concern over stagflation taking hold. So, if you recall, stagflation is slowing economic growth alongside inflation at the same time. Now, in this environment, the dollar tends to strengthen as people seek haven assets. And with bond markets falling in value at the moment, then the dollar becomes an obvious choice. In an environment where we get inflation expectations rising alongside rising economic growth expectations, then we tend to see the dollar fall. Now, that's the environment that was known as the reflationary environment. And it's the environment that the inflation trade I've talked about previously on these videos. That is the environment where the inflation trade does very well, as we had earlier in the year. So, for example, cyclical stocks did very well. Now, often, if you get the dollar right when allocating or choosing your investments, you get almost everything else right. Now, some analysts are suggesting that the dollar strength has run its course and we could start to see that trend reverse and it start to weaken. Now, if we do start to see the dollar fall, then we may re-enter a world where equities and bond yields rally at the same time again. So keep an eye on the dollar index, which measures the strength of the dollar against a basket of currencies for any clues as to the direction of the dollar's strength. Now, you can follow this on the iPhone app again, the stock app, if you search for dx-y.nyb. And if you go back and look at that chart over the last year, you can see the ebbs and flows, which also coincide with the market's narrative at the time of whether we were entering a period of reflation or stagflation. So this ultimately decided which assets won and lost over the coming months in each of those scenarios. So for now, it seems that the market consensus is that there is going to be inflation and it's here to stay, and that interest rate rises are coming. The question remains, what type of inflation will it be? Will it be stagflation or reflation? And that's been the question for much of 2021. And it seems that the dollar may hold the answer to that, or at least give us an early clue. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. You can find us on Twitter, Money to the Masses with the number 2. You can find us on Instagram, Facebook, TikTok, and of course, don't forget to subscribe to our YouTube channel.